I just want to say hi and welcome to the week ahead. I'm Tony Nash. We've got a couple of special items for this show today. First, Albert Marco is in Houston, Texas, so we're doing a live in-person week ahead with Sam. Tracy will be on Spaces eventually. We also have a special guest, Mike Smith, who's a partner at Avidian Wealth here in Houston. Second, this is our first Twitter Spaces, so this may be a little clunky and we may make some mistakes, so just bear with us if you don't mind. So Mike, Sam, and Tracy eventually, and Albert, thanks for joining us. I really appreciate the fact that you guys have come for today. We have a couple of key themes today. The first is how low will gasoline go? Gasoline prices, I think, nationally are around $2.99 or approaching that in the U.S. So, we want to take a little bit of a look at that to understand what's happening there. We also want to talk about inflation and recession worries. Sam will go into that quite a lot. And we'll try to figure out what's happening with inflation. And then we'll talk about Japan post 2% inflation. So there have been some comments about from Abe at the BOJ about Japan hitting 2% inflation. And we'll talk about that a little bit. Okay, so Albert's just joined us. So let's get started on gasoline prices. Guys, since June, RBOB has really come down from 430 to about 216. So it's about 50% or 49 point something percent. Of course, lower crude prices are a huge factor. We've seen crude prices come down in that time as well. So is there more to go on crude prices and on gasoline prices? Like I said, we're waiting for Tracy, but she's not joining. So I'm just going to throw it open to you guys. Like, what's your thought on gasoline? Because we're entering the holiday season. It's going to be a lot of driving. There's a lot of inflationary pressures, which we'll talk about in the next segment. But, I'm just curious what your thoughts are on room for gasoline prices to fall.
Well, I think the gasoline prices are going to fall because the price of oil just keeps on going down. I think at the moment, whatever, brokers, government entities, or whatever, whoever you want to talk about, is starting to drive down the price of oil because it's beneficial for the political situation. So I think that oil, as it drifts down towards 60s, mid-60s, the price of gasoline will also come down.
Okay. What are you hearing? We're in Houston, the energy capital of the world. What are you guys hearing?
Yeah, I would say it's hard to make a call on the energy price kind of in its relation to gasoline for a couple of reasons. One, we really don't know where any spare capacity can come from in terms of the ability to refine at this point, right? You're running at 96-ish%
right.
Utilization rates for refinery capacity. That's pretty much peak. So if you have
right.
any sort of hiccup there, you're going to have a problem on the gasoline front.
So hurricane season is over. Do you see any reasonable hiccups coming? I mean, obviously they'd be unexpected, but
when you're running at 96% capacity, it doesn't take much to have a small problem, right?
Right.
And if you go from 96% to call it 90% because of an accidental outage, that could be something rather significant for the gasoline market. So while oil prices, appear to be fairly volatile right now, it's hard to translate that back into a gasoline price.
Well, I know it's 86 degrees here in Houston, but
right.
Unpredictable winter can happen. I know it's
right.
a little bit of a delay, but we don't know these weather patterns can happen. We could have a colder than expected winter, and that could probably trigger as well.
Right.
Rail strikes is another issue. You're talking about any kind of strikes in the transport industry, diesel prices making truckers, trucking more expensive, anything to trigger it.
Yep.
Right. I just saw Tracy pop in and then she popped out. So once she comes in, we'll come back to her on this. Okay, that's great. And we're seeing we've seen XLE, the energy companies, the energy operators, we've seen XLE stay pretty elevated as crude prices have come down. There's typically kind of a 4 to 6 month lead between crude prices coming down and XLE coming down. So when we look at some of these major operators, is there an expectation that those prices will come down, or are we kind of, I'm just inviting Tracy to co-host. Okay, hi Tracy, are you there? Sorry, just back to XLE. So do we expect XLE, the traded operators like say ExxonMobil, those sorts of guys, ExxonMobil is about to break 100. They're headed back down after topping out at like 115, something like that. So do we expect their share price to follow the crude price directionally?
I would say no, really. It's tough. It's a tough call, to be honest with you, because we just don't know which way the markets are going to go. Crude prices is acting like Bitcoin at the moment, just being up and down 10% per week. So I couldn't even give you an honest answer on that.
Okay.
I mean, it's certainly not going to be the same data that you would expect in, call it, a decade ago. But you're likely to have, the sentiment at least have some effect on XLE or XOP, whatever it might be. But the issue now is that you're not going to have the same sort of capital expenditure catch up and overshoot that you did in previous cycles, simply because investors have already said, we will punish you for that. And producers don't want to be punished, right? They're making a lot of money at $50, $60, $70 a barrel oil. They don't, I don't think you're going to see the level of beta to the underlying that you would normally expect.
Okay, great. So basically they're using their old equipment at the current energy prices and they're maxing it out. But when the CapEx cycle does come on, will it come on with huge force, or will that trickle out? Like when will investors decide at some point that they won't punish these operators for CapEx?
No.
They won't?
No.
Okay.
I mean, why spend for something that has a 5 to 7 year time horizon, right? That's what we've been told, that the oil companies aren't supposed to exist, in a decade. Right. So as a shareholder, you want that return of capital. You don't want that capital put back in the ground. And if you begin to see any sort of significant uptick in capital expenditures, you're going to have that. You're going to have it absolutely crushed from a stock perspective.
Right.
If Exxon announced that they were going to begin a significant capital expenditure program, that stock would get absolutely hammered. And you can just go through any of the companies, right? It's all about, what are you doing for my dividend? How much stock are you buying back? And maintaining output, not expanding it.
Yeah, because you talk about it, will it be short or fast? I think it'll be short. I mean, it's going to take a long time for that to happen unless some major catalyst happens that actually sparks that in. I mean, think about how long it is to legislate, get permits, all
yeah.
things. I mean, it takes
forever. It's a decade.
Yeah,
right?
absolutely. So it's got to be some major catalyst that provides that.
Tracy, are you there? I see you as a co-host, but I'm not sure if you can speak. Okay. Once you're in, Tracy, just speak up, and I'd love to get you involved in this discussion. Sam, how much of an impact is say lower gasoline prices having on, say, the affordability in broader inflationary environment? So basically, are gas prices helping the inflation discussion much, or is it just a relatively small thing since a lot of people are working from home still?
I mean, there's kind of two ways to think about that. There's the inflation dynamics, right? The actual inflation dynamics that, lower gasoline does help that, right?
Yeah.
It'll help the headline CPI narrative.
It's a tax cut. I'm kidding.
The problem is that over time, gasoline has become a much smaller portion of the wallet, right? Mm-hmm. The average person does not spend anywhere near as much on gasoline as they used to.
Right.
And that's just a fact. So is it really helping people? I mean, on the margin, yes. Gasoline and groceries are the two things that you can kind of see, and one you see in a big bold sign, and the other you see every week when you go buy groceries. So gasoline and grocery prices coming down, that's good for the consumer mentality. Is it good for the actual spending levels? Nah.
Okay, great. Okay, guys, just so you know, this is a live Spaces. We are recording this and we'll upload it on the YouTube channel probably tomorrow. Tracy has joined us. Tracy, if you're there and you want to chime in, please join. Okay, let's move on to the next topic for inflation and recession worries. So inflation is proceeding pretty much unabated, Sam, and we saw this in your newsletter this week. And I'd love to talk more about that. We also had some Goldman guy, I can't remember who it was, out yesterday saying there's probably going to be a recession in 2023, and all these people are coming out saying maybe back half of 2023 there's a recession, which it's a convenient time to say that, right? Right now to say something's going to happen in the back half of 23. So you looked at the terminal rate in your newsletter. So how would, say, accelerated inflation, if that's actually coming, or the steepening of recession worries affect the terminal rate from the Fed?
Oh. So I think you have to divide that into the first part. That is, what would inflation, call it a deceleration in inflation pressures, mean for the Fed? Unless it's significant, not much. Does a recession matter for the Fed? Not if it doesn't come with disinflation. I mean,
right.
Does the Fed care if we have real GDP decline? No. I mean, we have real GDP decline Q1, Q2.
It's not their mandate.
They did not care.
Right.
You currently have north of 7% CPI, and you have an unemployment rate of 3.7, 3.8 maybe percent. It's really hard for me to see which one of those metrics is comforting to the Fed
right.
at this point. So does it affect the Fed's trajectory? Maybe it'll take a 25 out of the terminal rate, but that's about it. You're simply not going to have this type of immediate Fed pivot with inflation at north of 6% and this type of unemployment rate. It's just not going to happen.
Okay, great. Now, for you guys on Spaces, if you have a question or want to put up your hand, put a question in the channel or put up your hand. We'll take some questions later on in the podcast.
Yeah, that inflation, the inflation is just so sticky right now. I mean, we spoke about it earlier before the podcast about wage inflation just sitting there, just rising every single month. And, politically, it's a great thing for the people. They waited 40 years to get wage inflation. But I can't see how, all these consumer prices are going to come down. And talking about disinflation,
sure.
Wage inflation is just going to stay elevated for the next 10, 15 years.
Yeah, that's a good point. So I get that there's this expectation out there where people expect prices to come down to, say, 2019 levels at some point. And, we were talking about this, Sam. Do you expect prices to go back down to 2019 levels? We've seen a dramatic rise in a lot of different areas. So do you expect that to fall back down to what it was 2-3 years ago?
No, never.
Okay.
I mean,
no,
I don't. I just don't. I don't even think that in the best of all possible worlds, that's not one of the worlds.
No, the only people talking about that are the political people that are trying to sit there and trying to gain votes because people are struggling at the moment. But the economic guys are just
Tell you what you want to hear, basically.
Yeah, exactly. They're telling you what you want to hear. But the economic guys are looking at the numbers and like, we have never seen.
Possible.
I mean, why would companies bring the prices back down that much when they know they can get away with it?
Well, I mean, Cracker Barrel expects wages in the coming year to be up 5 to 6%.
Right. So for those of you who aren't in the U.S.,
next year.
Right. For those of you who aren't in the U.S., Cracker Barrel is a very kind of middle America restaurant, comfort food, right?
Yep.
It's biscuits and gravy, it's fried chicken, that sort of thing. And so this is not the high end, yet it's not McDonald's. It's very much the middle market in the U.S. And so Sam's done a very good job in his newsletter over the last couple of years covering price hikes at Pepsi, at Home Depot, at Cracker Barrel, at other places. So many of these companies have raised prices by like 8 to 10% generally,
or more.
More.
You look at
who's raised more.
So Campbell Soup this morning came out with earnings, and they divide them into two categories. They divide it into soup and kind of prepared meals type deals, and then snacks, right? So think Snyder's Pretzels is one of the brands. The prepared meals, which include soup, they increased pricing 15%. From last year, and they increased on snacks 18.
Okay.
And that was price that they pushed. Volumes were slightly negative, but negative 1% and 2%.
Okay.
I mean, we're talking almost no budge on volume
Right.
and a huge move in pricing. And that is for the most boring of all commodities. I mean,
Right.
this is soup we're talking about. This
But
is not.
And I want you guys to understand what Sam is saying. Campbell Soup has raised their prices between 15 and 20%, and their volume declined 1%. So do we ever expect Campbell Soup to reduce their prices by 18%?
No, and that's the beautiful part. If you're corporate America right now, is you get a free pass to really find the elasticity in the market for your product by raising prices until you begin to see pushback from consumers, and you
Right.
just haven't seen a significant pushback from consumers. And
Right.
to the narrative of inflation is peaking. If you look at the last 4 quarters of price increases from Campbell Soup, it was something like 6%, 11%, 16, right? So this isn't it may be maybe one, maybe the second derivative is negative,
Right.
but the first derivative isn't.
And it's not. It's positive in not a small way.
Correct.
We're not talking about 2% price rises.
No.
We're talking about 18% price rises, right?
Which is
Yes.
dramatic.
Which
Which
is
is-
We're
dramatic.
seeing that for consumers, the biggest increase, but I mean, I guess in the future years, that probably somewhat levels off. And then on top of raising prices, I'm sure all of you have noticed the shrinkflation. I mean, the
Sure.
items have less in it,
Yeah.
and we're paying more for it. So that
Right.
on top of everything else.
Yeah, well, and that is part of the pricing element,
Yeah.
right? So when they take packaging down a couple of ounces,
Mhm.
that shows up in the pricing mechanism.
Yeah.
As well.
Right.
So
And it's incredible that Campbell Soup and all these other companies raise their prices by 16 to 19% because that is actually the true inflationary number. When you go back to what they used to do in the 1990s, it's 18, 19%, not the 7% that the Fed tells you in CPI.
Right.
So, and on top of that, these inflationary numbers give you a tailwind for earnings. So all these companies that like surprise earning beats, well, if you look at what inflation has done to their products, it's not a surprise that they beat.
yeah,
Right.
and it's somewhat stunning because if you think about it from a 23-24 perspective, I mean, if you have your input costs begin to move lower or at least decelerate, and you're holding your prices at these current levels, or even increasing slightly from here, or increasing from here, all of a sudden you begin to think about what that does to a bottom line.
Mhm.
That is an extremely attractive thing for a business as we begin to move into the latter part of the 2020s. The margin
Right.
expansion that everybody kind of thought was over after COVID, that really might return to some of these boring, staid old stocks.
Right. So, so guys, just to be clear, what we're saying here is prices are not going to go down, or they're highly unlikely to go down to what they were 2 or 3 years ago. We've hit an inflation level. It's a stair step. And companies are comfortable seeing reduced volumes, but they've compensated that with higher price, and consumers are generally accepting higher price, right? So as an aside, I'll be shameless here and say, Complete Intelligence does cost and revenue forecasting. So if you guys need any help with that, let us know, okay? So terminal rate, you're still looking at 5 to 5.25, somewhere in there.
Well, I think it's probably closer to 5.5.
Okay.
To call it somewhere between, I would say 5.5 to 6, because you have the stickiness in wages,
Right.
and the stickiness in. Remember, this is important. That Powell, a week ago at the Brookings talk, pointed out one thing, and that was core services X shelter. In other words, they are already throwing shelter out. Like even when shelter decelerates, they're not going to pay attention to it. And he also made very, very clear that core services X shelter, the main input cost for many of these businesses is wages.
Yep.
And personnel. So while you have these wage pressures building, the Fed is not your friend in any meaningful
Right.
way. So I'm much more on the, give it 5.5 to 6.
Okay.
There's this idea of, maybe we get 50-50, 25 and then done, or 50-50 done. It's more like 50-50, 25 and 25 and 25.
Right.
It's just slower.
You said this a month or so ago. It's a matter of the number of 25s that we get.
Yes, it's 25 to life.
Okay, so it's not over, guys. It's, we're going to continue to see the Fed take action, and they haven't even really started QT yet. And we've talked about that for some time. And when they start QT is really when markets feel it. Is that fair to say?
Yeah.
Depends on the market, of course.
Yeah, and they've started QT. It's just that
Small,
well, it's
200 billion or something.
I mean that's still QT. They're not going to accelerate.
Right.
No.
I think one of the things he said is the Fed is not your friend. And just think about that statement for a minute. I mean, for 2 decades, all investors, we've all come to know as the Fed's our friend. Anytime the market was down, they're out there, doing press conferences. But I think it's critical for people to understand we're not going to see a return of that for a significant amount of time.
Right.
So
These are not public servants, right?
Exactly.
they don't like you.
No, and it's important, as Sam mentioned, that 50-50 and then the repetitive 25s, it correlates with their rhetoric of soft landing that they keep talking about. And, whether they can actually achieve a soft landing, well, that's another debate to talk about. But that's exactly what their intentions are. They'll do 25 us to the end of the earth until they get to where they want to be.
Right. Okay. Very good. Let's move on to Japan. Bank of Japan Chairman Kuroda was on the wires this week talking about Japan hitting the 2% inflation rate, which they've been trying to hit for 30 years or something. And then they made it policy with Abenomics in 2012, and they still haven't been able to hit it. And now that we have crazy inflation globally, they're going to claim the win, right? And they're going to say we hit it, and Abenomics, although obviously not empowering, was ultimately successful. So, Albert and Sam, I'm just curious, what does that mean? If Japan hits 2% inflation and they tail off their quantitative easing, their kind of QE infinity, and they stop buying government bonds, all this stuff. First of all, do you think that's going to happen? Okay. And second, if that does happen, what do Japanese markets look like? And then what does the yen look like? I realize I just threw a bunch of stuff out there, so just take it away. Mike, jump in here.
Sure.
The fiscal monetary setup is quite favorable, right? If they do whatever they're going to say they're going to do, it's quite favorable. Their only headwinds that I can see is the U.S. stock market equities. If the U.S. equities falls, without a doubt, it'll affect the Asian markets, specifically Japan. So, I mean, it's a tall order for them to sit there and get their 2% inflation target. So I don't even know if that's even a valid, discussion. But I guess we'll sit there and talk about it.
Sure.
I still, as much as the setup is favorable for Japan, they're combating China, and I still think that China, because they don't have as much connection to the U.S. equity market, is a little bit more favorable. I would go with China over Japan right now, but that's
but I'm tired of talking about
China.
China.
I know.
It's hard.
It's hard not to talk about China when Japan is so interconnected with China, the U.S. is, and everything. So everything is interconnected in that region. But I do think that the fiscal monetary setup for Japan is favorable.
Okay, Sam, what do you think?
I mean, like Albert said, it's theoretically it's really interesting. It's intriguing. The one thing that I think is important to remember about Japan is that every time they seem to have the monetary policy setting correct, and they were heading to actually hit their 2% target, they always seem to raise taxes or do something to make sure that they missed. It was MMT on steroids. It was a very good example of MMT actually working, right? You can do as much monetary policy as you want, as long as every time you're close to an inflation target, you just raise the VAT or taxes. And so I think that's something that I'm always somewhat skeptical of Japan doing. If they begin to lift yield curve control on Japanese government bond yields, I think it'll do two things. One, it will make for an interesting market in Japanese bonds. The BOJ owns such a large amount of that market that it's almost difficult to fathom that it actually has a functioning market. It doesn't really have a functioning yield market. So that's kind of the first thing is we'll finally get a feel for how that market actually functions. The second one is that you've had a 2% inflation win with the yen sitting between 130 and 150, a very weak yen. That's a tailwind to inflationary pressures. If they do lift YCC, it doesn't matter if they what else they do, if they raise interest rates, whatever it might be. The yen going back to 120 is going to undo a lot of that inflation pressure in and of itself. You're going to really rein that in. And it's also probably a positive, having a stronger yen in this environment when you're at an energy shortage globally is a positive for the Japanese economy because they import so much energy. Having that stronger yen makes it cheaper in domestic terms from that perspective. So I think there's a number of things that could line up pretty well, and there's always the opportunity for the Japanese government to mess it up somehow. So,
of course,
I do think that it's a very interesting market, particularly if you can do it on call it a outright basis, investing, and get some of that currency dynamics mixed in with your investment. That could be a very interesting opportunity going forward.
What's interesting is what you're saying about MMT on steroids. It's like, you're making all these descriptions of what's going on in Japan, and I just look at the Fed and I'm just like, well, oh my God, we're starting to be on the verge of Japanification at the moment right now, because a 30-year bond, from who I talk to, the 30 years is completely controlled by the Federal Reserve at the moment. It's completely controlled. And if they can sit there and pump those bonds and then pump the markets, and you got Japan right here in the United States with MMT and Lael Brainard and Yellen doing whatever they want to do with it.
Yep.
Yeah. You just have to raise taxes.
Yeah. So
we're masters at that.
Yeah. So I used to go to Japan a lot, and in the late say 2010, 2011, when the yen was at like 75, when I would go to Tokyo and I would go down to breakfast in the hotel, I was the only one there. And I remember when Abe was elected, and even pre-election, the yen started to weaken, or pre him taking office, the yen started to weaken, right? And I remember the first time I went down to the hotel lobby and there was a line to get to breakfast rather than just it being wide open for me. So a devalued yen means a huge amount of power for the Japanese economy. So when you say JPY going back to 120, I remember in 2010, 11, when people would say, gosh, if we just had a yen at 95, we'd be happy, right? And now it's at 145 or whatever it is. I haven't looked for a couple of days.
Yeah.
136. So, it's a completely different environment and puts the Japanese economy in a completely different context. But you have nationalization of bond markets, you have nationalization of ETF markets. And so is it really an open, competitive economy? It's certainly a highly centralized economy, right? So, and that's really dangerous, but they love to use demographics as the justification to intervene in markets, right? So, okay, guys, if anybody has a question, raise your hand, or I'm not exactly how this works. Again, this is our first time to do a Spaces. So put something in the messages, or raise your hand, or do whatever, and we could potentially have you come on and ask your question. I'll be very honest, if you have an anonymous Twitter handle and we don't know you, I'm not going to let you speak, so don't waste your time. But if you're someone we know, then we're glad to have you on. So I guess while we wait for people to come in with questions, we're Christmas holidays here in the U.S. We've got a Fed meeting coming up. The expectation is for a 50 basis point hike. Like, what do you guys expect? We're seeing equity markets really kind of gradually move lower. What do you guys expect for the next week or so in the U.S. before the Christmas
I
holidays?
think that will be. I think the CPI is actually going to be a little bit less than consensus, and probably going to rally going into the end of the year. To be honest with you, I think everybody knows it's going to be 50 basis points. The question is like, what's the guidance after that? What do they say? If it's a good CPI number, well, then you can have this dovish talk, for another month.
I mean, sentiment's been so low, and you kind of got your seasonality right now. I think that probably prevails here. If you think about it, a few months ago, everybody was kind of in this panic. It seemed like people there's this nice little calm right now. It's just everybody's just kind of, floating around, waiting to see what's next. And like to your point, I think everyone expects to raise another 50 basis points.
Yeah, which is amazing because 50 basis points is not dovish.
Exactly. Yeah.
But I guess in this day
True.
and age, yeah, sure, okay, 50 basis. I guess everyone was expecting 75 or 100 about a month ago. You know what I mean?
But they're conditioned us to think
Yeah.
it's okay, right?
Yeah, exactly.
Conditioned over the last 3 months.
Yes.
Yeah.
Yeah. No, I would say there's a couple of interesting things about the Fed meeting and into the back half of the year. One is, what does the dollar actually do here? Because if you begin to actually have a significant move in CNY, stronger, right, lower on its chart, but if you get a significant move back towards the 650 area on CNY, that is going to have a spillover effect to a stronger euro, continued strength in the British pound. You could begin to have a number of dynamics that are somewhat negative dollar and therefore pretty bullish on the risk asset front that I think could catch some people off guard. Simply because of the spillover effects. But the Fed, the one thing to remember about this meeting is it's not just a 50 basis point hike, it's also that stupid dot plot that they do. And that actually has some pretty serious potential consequences.
Yeah.
Because if 23 comes out with higher than expected dots and 24 dots move higher, if the terminal long-term rate begins to creep a little bit higher, if you begin to have that hawkishness, I kind of want to say this, so I'm going to. If you begin to have the hawkishness become less transitory in the dot plot, that could become somewhat problematic for markets. That could, take some of the sales out of what we've seen to be a moderating dollar effect. So I think it's worth being a little careful until we see that dot plot and begin to hear how Powell is approaching 2023. Because I think they're somewhat aggravated about the way that the Brookings institution, the Brookings speech was received by markets. They did not want a significant asset rally going out of that, right? That was counterproductive to what they want. So I think they're going to be very careful about the rhetoric into the back half of the year.
But if they would just not be so jerky in their communications.
Well, Tony.
I mean, they're super bearish, they're bullish, they're super bearish, they're bullish. There's like, guys, just have a consistent message.
Yeah, but it depends on what's going on behind the scenes. What data? Because they see all this data. They see all the CPI and the jobs numbers a week or two ahead before anybody else. Don't kid yourselves, right? So I guess it comes down to what is going on behind the scenes and what they don't want to break. I mean, Blackstone can't. From what I heard, Blackstone was $80 billion in the hole and having problems. And they went to the Fed, and that's what triggered Powell to be slightly dovish in his rhetoric.
I thought they were the Fed.
Well, whenever you got Powell's portfolio sitting there in your grasp, you are the Fed at that point. But it's just, I guess it goes down to like what is happening behind the scenes and what could potentially break is why they're coming on this like roller coaster ride of rhetoric.
Yep. Okay. I'm going to see if Valina wants to come in. She's attending, and see if she wants to come in to see what.
Good old Valina.
Invite her to speak and see if she wants to. Valina, are you there? If you want to come in and let us know what your thinking is going into the end of the year and 2023, you have an invite to speak. You're welcome to.
Valina's sitting there in Austria, Vienna, Austria, and the European markets right now are looking quite interesting to me. The luxury market in Europe is absolutely exploding.
Yes.
And it's just unreal that it's just so resilient. I mean, there's two brands that I personally like, Loro Piana and Brunello Cucinelli, which I have a tremendous amount of clothes. Brunello Cucinelli didn't care anything about the Russian sanctions or anything; just kept on selling, and they just blew out earnings.
Yes.
Or is it today? They blew them out. Anyways, they were up like 7% this morning.
Yeah.
The luxury,
Really?
the luxury retail market, luxury jewelry market is just it doesn't stop.
Great.
And it's counter to what everybody's saying. Recession this, recession that. You go to Gucci stores, the lines out the door. Louis Vuitton, you need an appointment. It's just resilient. It's just actually quite amazing.
It is really.
And part of that, similar to if you look at art markets, right, particularly the masters, plotted against the price of oil. If you do a 6-month delay, guess what?
Sure.
It's a really interesting kind of windfall type chart where you can kind of see, the oil money flowing in there. And, you even had China relatively shut down, right? And that was a huge driver, a tremendous driver of European luxury, particularly for LVMH.
Yep.
Even with China shut down and not really having the tourism, you had a lot of tourists from Middle East, et cetera,
Absolutely.
really some of the call it South American countries that are doing fairly well, particularly at the higher end. A lot of that is driving this, that kind of underneath the surface, you had tech, then you had energy, and the question is now you have the China reopening. Is that the next leg for a lot of these luxuries?
Okay, so let's talk China. I wasn't going to do that. Tracy,
I was doing
if you can, you're as a speaker as well, Tracy. So if you want to come in, you can come in anytime. Okay, so let's talk about China, even though I didn't want to cover that. So let's talk China. What's happening, Albert, with the reopening? Like, what do you see the next 2 months happening with China?
Just as we spoke about a week ago on China, is those riots and the reason the Chinese even let you see these riots happen on the social media was a signal that they were going to reopen, and in fact they did days later. They
Right.
said we're reopening in stages, and that's just it. And get your house in order, everybody, because inflation is going to happen. I think copper was up like 2.5% this morning.
Yeah.
And this is they're just barely reopened right now,
Right.
manufacturing, because like the orders were down. I think Western orders were down 40%.
Because everyone told me on Twitter that democracy came to China. So
Yeah, okay. Well, those are people that had never been to China or stayed at 5-star hotels and
Right.
never actually stepped foot outside of
Okay.
outside of Beijing.
So let's go there a little deeper. And Xi Jinping is in the Middle East either today or over the weekend at a Arab China summit, right? And so, first of all, him leaving China right after there were protests. What does that say to you, Albert?
Safeguard. He's done. Any kind of opposition that was pushing against Xi's party Congress moves is just eroded.
Okay.
These street protests are they're just street protests. I get it. People are upset and their livelihoods and check down the list of whatever you want to say. But
Right.
realistically, they never work unless they get violent, and they never got violent.
Right. So you kind of have to let the steam come out of that valve, I think is probably what you're saying, right? The CCP is saying that. Now, with Xi Jinping going to the Middle East, Sam, they are the premier buyer. China is the premier buyer from OPEC Plus now, right?
Yes.
It's not the US. So, and this isn't new. For people who have been paying attention, the Saudis and other people in the Middle East have been spending a lot more time in Beijing for probably 6-7 years. And so, and it's been longer, but it's been really, really visible for the last 6 or 7 years. So what does that tell you about, let's say, OPEC's desire to please, say, a U.S. president going to the Middle East to try to bully them to pump more? Is that effective anymore?
No, not at all. I mean, all you have to do is go.
Hi, Tracy.
Hi, sorry, I was having technical difficulties, and for some reason I couldn't log on earlier.
Well, welcome.
So I do apologize.
No apology necessary. We're just talking about China and with Xi Jinping in the Middle East for a summit with the Saudis and the GCC members, and what that means for the ability of, say, a U.S. president to kind of bully OPEC into reducing oil prices going forward. Is there really any strength there, do you see?
That's absolutely done. I mean, what I would expect, she landed in China today. I would expect him to get the full, lavish welcome, right? And we want to be looking at who he brought with him as far as national heads of corporations. And I would expect this to be completely opposite of what we saw the Biden meeting with, and more akin to what we saw the Trump meeting with, where they, I would expect that.
So they'll touch the crystal ball.
Yeah, well, maybe they might bring out the ball, yes. And I expect billions and billions of in new deals as far as economic, military, energy in particular, etc., going on at this point. Again, they're having a conference where they're going to have multiple leaders in the Gulf nations, in Saudi Arabia. So, I mean, they're really going to, try to woo China on this trip, big time.
Right. So when you talk about military deals, what do you think about that, Albert? So,
I'm not really.
do you think Saudi Arabia will do major military deals with China?
I mean, they will. Maybe a few, just for
Okay.
show, for optics and theatrics. But the U.S. military hardware is the best in the world, and realistically, Saudi Arabia is under the U.S. defense umbrella. Whether the left or the right likes it or not, that's just the reality of it. And as long as Iran is not poking trouble from the east and Yemen not from the south, the Saudi Arabians have an easy ride. So their military deals aren't really, they're not at the forefront at the moment. But anytime that Russia wants to strain that relationship, they can certainly, call up Tehran and say lob a few missiles over and things go, right to hell again. But we're no longer there.
I don't. Yeah, to Albert's point, I don't think Saudi is going to, or KSA is going to become the next India, where they split their arms deals, among the three major powers of arms anytime soon. I mean, that's just not going to happen.
No,
there will be a little, but
yeah, there's just theatrics. But India's a completely different ballgame. India's got counterbalance. They need to counterbalance Russia with China and Pakistan, and it's a whole mess over there.
Yeah,
and they need to do what they're doing.
Well, and KSA is also trying to hold together their market share in a world of Russia really having to begin sending almost all their stuff to, call it, China and India.
Right.
So if you had, what were the two largest pieces of growing market share for Saudi Arabia over the past decade? That was India and China.
Of course.
And now you have the other major energy player in the region coming after your market share. There's got to be a little handshaking here to keep everybody happy. And selling at $55 a barrel. I mean,
you can't. You don't hate that, right?
If you're China, I mean, it's the perfect time to reopen. You're getting cheap energy.
Mm-hmm.
You have supply chains that have fixed in the rest of the world. So I think this is very much a visit to make sure that they can continue reopening, get those long-term energy deals in place, and then move forward.
Right. Okay. So we do have a question for Tracy, and you guys jump in. So Tracy, there's a listener named Rasul, and he's asking, when China opens up, is it possibility that it could use its own SPR, like in November 21? To reduce its oil cost? Is that something they would consider doing?
I think not at this juncture right now because, first of all, they've already drawn it down, right? And they're still worried about long-term energy security, as is everybody right now. In addition, they're also getting really cheap Russian oil. So I don't think that would be something that they would do right now.
Okay.
No, they wouldn't do that. Right? There's absolutely no need to do that. And the U.S. only did that because of midterm economics, and that was just that. It wasn't really. China has no intention of doing something like that.
Great. Okay. Good. All right. Well, guys, I think we've covered it. We've been here for about 40 minutes, and the hotel we're in has threatened to call the police if we don't leave. So I want to thank you all for joining us for this week ahead, and we'll get this posted on our YouTube channel within a day or so. Okay, so thanks for joining us, and look forward to seeing you on the next one. Thank you.
I was just waiting for the guy to come in with the hook and get us out of
Yeah,
here.
me too. Yeah.
Get the hell out.
He was a dick. He was like, can't do it. I'm like, oh, she